Here's how it works 100% of the time. Number one, get all the match you can get, because 100% return on your money, which is a match, you can't screw that up with taxes or a bad investment. Then the second thing you do is all the Roth you can get. Then if you still hadn't gotten to 15% and the only other option available to you is non-Roth or traditional, then I would do it.
Let's face it, investing can be scary at first. Questions like, what if I don't make the right investment? Or what if I lose everything? Can keep you from taking any risk at all. But avoiding risk is a huge risk itself, because the money that sits in your wallet or your bank account loses value over time. Today, I'm going to help you get off the sidelines and start making smart investment decisions that can ultimately lead to wealth. Even better, these tips are taught by one of the best-known financial experts in the game, Dave Ramsey. Dave is a popular radio personality and author who gained fame for hosting The Ramsey Show. Having understood the value of working from a young age, Ramsey hit the 1 million net worth milestone at just 26 years old. He would, shortly after, file for bankruptcy before dusting himself up again to start over. Fast forward to today, he has amassed a fortune worth hundreds of millions of dollars. And that is a level of success worth studying. Now, before you dive into the investing world, you'll want to begin with several basic steps to set the proper foundation. Dave Ramsey calls these the 7 baby steps. Let's quickly mention each of them, because they're vitally important to build a healthy financial foundation. You'll notice that investing actually begins at baby step number 4. After that, we'll then talk about the investment process itself, including some different types of investments so you can get off to a good start. Baby step number 1. Save $1,000 to build your initial emergency fund. This is your safety net in case an unexpected expense emerges. Step 2. Pay off all your existing debts, aside from your mortgage. Ramsey recommends the snowball method. This is when you start with the smallest debts, which you can pay off quickly, and move up the ladder to the larger ones until all your debts are paid down to 0. Step 3. Build up a larger emergency fund to cover 3 to 6 months of living expenses. If your income ever takes a significant drop or gets cut off completely, this larger emergency fund will be a major help. To figure out how much you should save, you'll want to create a monthly budget first. Step 4. Save 15% of your paycheck and put it towards retirement. Your later years will be here faster than you think, so start preparing now. This is the step where your initial investment journey begins. Step 5. Start saving for your children's higher education. College is super expensive, so if you have kids, setting aside money sooner than later will save you a ton of financial stress. Step 6. Pay off your mortgage. With no other debts to worry about, you can now focus on paying off your home with greater focus. Step 7. Build your wealth and be generous. At this stage, you can explore more investment opportunities to grow your fortune. Now, steps 1 through 3 should be progressive. Then, depending on your financial status and how much you're willing to sacrifice, steps 4 through 7 can be done simultaneously. That said, investing may still feel intimidating, even with the baby steps locked down. But think of it like this. New things are scary simply because they force you to look beyond your comfort zone. Fortunately, Dave Ramsey makes investing a lot easier for beginners. So, if you have questions, doubts, or simply lack the confidence to take that first step, here are some detailed tips to get you on your way. Part 1. Figure out the why. Before you say, let me put my money in stock ABC or fund XYZ, take a step back and ask yourself why you want to invest. For example, are you doing it to secure a better retirement? Perhaps you want to buy a home, or maybe you want to establish a new source of passive income to supplement your job. Knowing your end goal is the first thing you want to do when investing. With a defined goal, figuring out most of the other steps becomes a lot easier. Part 2. Decide how much. Now, rather than investing whatever you have left after spending your paycheck, Ramsey recommends having a structured plan. The goal here is to have a savings rate that you can stick to long term. For instance, in the 7 baby steps we covered earlier, Ramsey talks about dedicating 15% of your income to retirement. If you were to invest that 15% consistently from, say, 30 years of age, you'd be on track to become a millionaire in your retirement years. This is thanks to the power of compound interest, where your interest earns you even more interest without having to actively work for it. By the way, the withdrawal rules at the time of this video state that you can begin withdrawing your funds starting at age 59 and a half without penalties. Now, retirement is just one part of investing. If you want to invest beyond a retirement account and build wealth faster, you'll also need to figure out how much you can allocate for that. Once you know how much you can set aside, you can automate deductions from your paycheck so you don't have to remember to do it each month. Part 3. Examine your investment options. At this point, you know why you're investing and how much. The next crucial question is, where should I invest money? Choosing the right assets or securities is crucially important to help you reach your goals. After all, how an asset performs determines, at least in part, whether you win or lose. So, how do you choose the right investment vehicle for you? First, you must understand the options that are available to you. There are dozens of options on the market today, but you don't need to get lost in the complexity of them all. As a beginner, it's best to stick to well-known asset classes and types because their performance and risks are better understood. More importantly, many of them have a track record, so some quick research can tell you how they've performed over the years. Let's quickly look at a number of them. The first category involves short-term savings. Once you've begun setting aside 15% of your income for retirement purposes, you might be interested in saving more money in the short term. Here are some to consider. Certificates of deposit. A certificate of deposit, or CD for short, is a type of savings account offered by a bank or credit union. You deposit a fixed amount of money for a fixed period of time, which can be a number of months or years, and in return, you earn interest. Interest rates on CDs are often higher than those of traditional savings accounts, but generally, you don't want to use this as a long-term investment instrument as the interest isn't too great. Money market accounts and high-yield savings accounts. These are also great for short-term savings. Not only are they low risk, but they also tend to pay a better interest rate than you typically get with a traditional savings account from the large banks. Since they are highly liquid, they are great for funds you may need to use soon or don't want to tie up, like your emergency fund. Index funds. These are a type of mutual fund designed to track a market index, like the S&P 500 or Dow Jones. As an investor, your returns are based on the performance of the index, which in turn is dependent on market conditions. This low-risk investment is a great option for short-term goals that may take a few years, like saving for a down payment on your home. Remember, while short-term investment vehicles are great for short-term goals, they aren't necessarily the best for building wealth. For this, you want to go with long-term assets. Here are some of them. Individual stocks. Stock, or equity, represents a small piece of a company. When a company wants to raise funds, it may go public in what's known as an initial public offering, or IPO. What happens is the company sells small units of ownership, known as shares, to interested buyers, like you and me. Keep in mind that single stocks can be quite risky. So, even though the potential for a good return could be high, you could lose it all if you don't spread out your risk. Bonds. Contrary to a stock, bonds do not represent ownership. Rather, they are a loan between you as the buyer and a larger issuer, which can either be the government or a corporation. Essentially, you loan the government or another company an amount of money for an agreed-upon interest rate that is paid periodically. The length of time it takes for you to get paid back in full, called the maturity period, can vary. Bonds that have longer maturities often have higher interest rates. That said, bonds usually don't fluctuate as much as stocks and are considered relatively low risk. However, there's always some level of risk involved. For example, when interest rates go up, bond prices tend to fall, and vice versa. Mutual funds. Mutual funds are actively managed by investment professionals. As a fund, they pull money from different investors and put it into a basket of assorted securities, which may be a blend of different stocks and bonds. This allows you to invest in a lot of companies at once, rather than trying to pick stocks on your own. The benefit of this is that mutual funds spread out your risk and can help your money grow more consistently over the long term because they are not linked to a single company's performance. Exchange-traded funds. These are also called ETFs for short, and they are quite similar to mutual funds in that they are pooled investments. They are also very similar to index funds in that they track a particular index. However, a big difference is that ETFs are passively managed, meaning there are not any managers actively trying to outperform an index. Instead, the goal of an ETF is to reflect the performance of a broader index, and it does so by holding identical or similar securities in the same proportions as the index. The managers buy or sell the securities in an ETF only as needed to correspond with changes in the index. Additionally, ETFs are traded throughout the day on an exchange just like single stocks, and they can yield solid returns, especially if you reinvest the dividends. Retirement plans. Lastly, we have retirement plans, like the 401k, traditional IRA, and Roth IRA. These are true long-term investment strategies. However, let's make something very clear. They are not investments themselves. Rather, they are investment accounts that hold your investments. Think of them like a digital wallet, and inside of that wallet, you place the securities you've purchased. The benefit to placing your assets inside of a retirement account, instead of keeping them in a regular brokerage account, is that they have tax advantages. Some, like a traditional IRA, allow you to receive a tax deduction up front while experiencing tax-deferred growth. Tax-deferred means you won't pay taxes until you start withdrawing the funds in retirement. Others, like a Roth IRA, do not give you a tax benefit up front, but they do allow your investment to grow tax-free, and they allow you to avoid taxes when you withdraw the funds in retirement. Part 4. Design your strategy. You can choose the do-it-yourself route, or you can get an investment advisor to assist you. It's all about skill, preference, convenience, and cost. Whatever you choose, always remember the importance of smart diversification. That way, if some investments don't perform as expected, you'll have other stronger performers that can help bridge the gap. Part 5. Open your investment account and start investing. Looking back to Dave Ramsey's Baby Steps, you're ready to start your investment journey once you're at baby step 4. If your job offers a retirement plan like a 401k, that's often a great place to begin. If it's a standard 401k, you could consider investing up to the match that your employer gives. Once you've done that, you can continue investing into a Roth IRA that you open yourself until you've maxed it out for the year. From there, if you still haven't invested at least 15% of your income, you could go back to the 401k until you've met the 15% goal. On the other hand, if your employer offers a Roth 401k with a strong selection of funds to choose from, then you could simply invest your 15% there. In the end, the goal is not to attempt to beat the market with complex schemes. Rather, your goal is to buy strong-performing funds with a proven track record, hold onto them for the long term, and allow them to continue appreciating over time. If you enjoyed this video and would like to see more like it, give this one a like and subscribe to the channel so you can be notified when the next one becomes available. I look forward to seeing you there.